How is everybody doing today? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today we're going to be talking about two reports from the OCC. Both of these reports are first quarter 2025 reports. The first report is the OCC Mortgage Metrics Report. We're going to see how are residential mortgages performing in the market right now. The second report is a quarterly report on bank trading and derivatives activities. I think one of the most interesting reports that I always like to look at. And we're going to dive into the first report right here. So we're going to look at the press releases for both reports, and then we're going to look at the actual reports themselves. Now, one of the things I like about both of these reports is they're both relatively short reports. They're both basically about 14 or 15 pages in length, give you nice little glossaries at the end with a lot of the terminology in case you're unfamiliar with some of the terms that are used in them. But for the most part, very good reports. But let's jump in. So this is the first report here, the OCC reports mortgage performance for the first quarter of 2025. So the OCC reported on the performance of first lien mortgages in the federal banking system during the first quarter of 2025. The OCC Mortgage Metrics Report showed that 97.6% of mortgages included in the report were current and performing at the end of the quarter, an increase from 97.4% 1 year earlier. The percentage of seriously delinquent mortgages that are 60 or more days past due, and all mortgages held by bankrupt borrowers whose payments are 30 or more days past due decreased from the first quarter of 2024. Servicers initiated 10,667 new foreclosures in the first quarter of 2025, showing an increase from the previous quarter and an increase from a year earlier. Servicers completed 7,889 modifications during the first quarter of 2025, a 7.6% increase from the previous quarter's 7,332 modifications. Of these 7,889 modifications, 7,267 or 92.1% were combination modifications that included multiple actions affecting the affordability and sustainability of the loan, such as an interest rate reduction and a term extension. The first lien mortgages included in the OCC's quarterly report comprised 20.1% of all residential mortgage debt outstanding in the United States, or approximately 10.9 million loans totaling 2.7 trillion in principal balances. So for the most part, I think things looking pretty good. This is the report here itself. Like I said, it's only 14 pages in length. I am going to blow this up a little bit just so everybody can kind of get a better glimpse of this. And so here is our contents here. Basically, we go through, gives us some nice figures, an executive summary to start out with, some nice figures. We get the number of mortgage modification actions, number of modification actions and combination actions, changes in monthly principal and interest payments by state, number of redefaults for loans modified 6 months previously. And then, like I said, we get some definitions at the end. So we're going to scroll down here. Like I said, we kind of went through the overall gist of the modifications and things like that. So here, I just want to show you guys some of the charts in here. So figure one, total serviced mortgage portfolio, outstanding principal in billions of dollars. You can actually see we've actually been coming down here. So again, 2.8, I believe this is in billions of dollars. So 2.8 billion, and then coming down here to about 2.7 billion. So it has been coming down a little bit here over the last about year and a half. And then the next figure here is figure two, total serviced mortgage portfolio, number of loans in thousands. And again, you can see here from the second quarter, we kind of peaked out here more recently in the second quarter of 2023 at 12,032, and now down to about 10,862. So the number of total serviced mortgages in the portfolio coming down a little bit there. Figure three, composition. So loans in thousands by borrower risk category. So orange being other, blue, light blue being subprime, the yellow being alt A, and then the blue, regular, I was going to say darker blue, being prime loans. And you can see obviously the vast majority here, I would say over 90% are in the prime category. Only a very small bit are in the other subprime or the alt A category, which is good. I mean, that's what you'd like to see. Figure four, composition, percentage of mortgages by borrower risk category. And again, you can see here, 95% in the prime, only a small 1% basically in alt A, 2% I'm sorry, no, 2% in Alt-A, 1% in subprime, and just 2% in other. So again, 5% making up the Alt-A, subprime, and other category. 95% are in the prime category. Figure 5, number of loans in delinquency and foreclosure in process, loans in thousands. You can see here from the first quarter of 23 to the fourth quarter of 2025, we're coming down just a little bit there, not a lot, but just ever so slightly from about, current and performing 11,720 in the first quarter of 23 to about 10,598 in the first quarter of 25. Not many foreclosures in process, not many seriously delinquent, 30 to 59 days past due. Again, nothing really too crazy. Figure 6, percentage of loans current and performing and in delinquency. Again, you can see current for the first quarter of 2025, 97.6% are current, only 1.2%, 30 to 55 days delinquent, only 1% seriously delinquent, and only 0.2%, 0.2% in foreclosure process. So again, looking pretty strong, pretty healthy at the moment. Now, here's an interesting chart. Figure 7, newly initiated foreclosures. You can see here in the first quarter of 2025, we actually had newly issued foreclosures actually spiked up. We were in the fourth quarter last year, we were basically at 6,647, and that has jumped up to 10,667. So quite interesting, kind of matching the same area we saw. So the first quarter of 23, it was at 11,459. So about 800 less than 2 years ago in that first quarter of 23, but definitely a little spike up in activity there. So, and then figure 8, completed foreclosures and other home forfeiture auctions. Again, a little bit of spike up there from the fourth quarter of last year and a little bit of a spike up compared to the last 3 quarters, going back to the first quarter of 24. But again, nothing too crazy, but something just to keep mindful of. Now, the rest of this stuff is just kind of, charts on the number of mortgage modifications actions. We're not really going to look at that. And like I said, if you scroll down here to the end, there is a nice glossary appendix of definitions and methods at the end here for if you're not familiar with any of the terms that are used in there. So now let's jump over to the quarterly report on bank trading and derivatives activities. So what were some of the key findings here? So cumulative trading revenue at U.S. commercial banks and savings associations was $15 billion in the first quarter of 2025. Trading revenue was $408 million, or 2.7% less than in the previous quarter, and $297 million, or 1.9% less than a year earlier, as of the first quarter of 2025. So a total of 1,213 insured U.S. national and state commercial banks and savings associations held derivatives. 4 large banks held 87.1% of the total banking industry notional amount of derivatives, obviously the big 4 banks. Initial credit exposure from derivatives before netting decreased in the first quarter of 2025 compared with the fourth quarter of 2024. NCCE decreased $21.3 billion, or 7.9%, to $249 billion. Derivative notional amounts increased in the first quarter of 2025 by $23.9 trillion, or 12.8%, to $210.4 trillion in total. Derivative contracts remain concentrated in interest rate products, which totaled $141 trillion, or 67% of total derivative notional amounts. One of the things that I find fun and terrifying about this report is looking at the derivatives. And again, so here's the report here. Now, this report is 50 pages, but it's really only a 16-page report because you get again, you get a couple pages of glossary terms at the end, and then you get about 38 pages of, like appendix information that goes into this. But again, we're going to blow this up real quick so that everybody can get see that. So quarterly activity, bank on trading. And again here, so we have kind of executive summary, revenue, and then it goes into counterparty credit risk, and then it gets into market risk, and then, like I said, glossary of terms, page 14. So it's actually only about 12 pages, and then appendix, index of tables and figures. So these are short reports. Here you get about this report, executive summary of things we just went over. Again, the revenue there, we said about 14 billion in revenue. A little bit down revenue, again, slightly down from the fourth quarter of 2024 and from a year before. Holding company trading revenue actually did not too bad, actually better than from the fourth quarter of 2024. So up quarter over quarter, but down a little bit year over year. Again, bank trading revenue as a percentage of consolidated holding company trading revenue was up again pretty good here in 2025, not too bad. And then it talks a little bit about counterparty credit risk. Counterparty credit risk is a significant risk in bank derivative trading activities. The notional amount of a derivative contract is a reference amount that determines contractual payments, but it is generally not the amount at risk. The credit risk in a derivative contract is a function of several variables, such as whether counterparties exchange notional principal, the volatility of the underlying market factors, in other words, interest rate, currency, commodity, equity, or corporate reference entity, the maturity and liquidity of the contract, and the creditworthiness of the counterparty. Credit risk in derivatives differs from credit risk in loans because of the more uncertain nature of the potential credit exposure. Because the credit exposure is a function of movements in the market factors, banks do not know and can only estimate how much the value of the derivative contract might be at various points in the future. Let me say that again. Because the credit exposure is a function of movements in the market factors, banks do not know and can only estimate how much the value of the derivatives contract might be at a various point in the future. So again, understand your risk. And then it goes through more into credit exposure, but we can see here trading instruments, obviously the different types of contracts, interest rate, FX, equity, commodity, and others, credit. And then it kind of goes into like gross negative fair values, but I want to get down to... So again, I want to show you guys this figure here real quick. So figure 2, net current credit exposure in billions of dollars. You could see here that in the fourth quarter of 2008, you're up at 804. I think that's in billion. Yeah, in billions. Yeah, 804 billion. But yet down here, the first quarter of 25, we're down to about 254 billion. So you can see a lot less. And this is kind of a theme here. When you look at these reports, the risk is a lot less than it was going back to 08 in terms of, a lot of the dealings with the derivatives. So while the overall market of derivatives might be much larger, the overall risk, at least what they're estimating, is a lot lower. That's basically what you should take out of this. And let's go down here. Let's keep going down. I want to look at, so then it gets like market risk, value at risk here, some totals here. And then we get into volatility here, volatility index, the VIX. You can see here, VIX is, first quarter 2025 was basically at like 21.7%, pretty average, nothing really out of the ordinary there. And then it gets into here, again, another interesting thing, level 3 trading assets. So you can see here in this chart, level 3 trading assets in billions of dollars. Again, the fourth quarter of 2008, 204 billion in level 3 assets, and in the first quarter of 2025, that was way down to $34 billion. So again, kind of a deleveraging over time of the system and much less risk, at hand. And it says in here, another measure used to assess market risk is the volume and of changes in what's called level 3 trading assets. Level 3 trading assets are assets whose fair value cannot be determined by using observable inputs such as market prices. Since the peak of the financial crisis at the end of 2008, major dealers have reduced the volume of level 3 trading assets because the model inputs that determine the fair value of these exposures are not derived from observable market transactions. Banks use their own model assumptions in determining their fair values. So again, trying to take that risk. They're trying to take that risk down. And then it gets into notional amounts of all derivative contracts. And you could see here, and again, this is the crazy number. So all derivative contracts for the first quarter of 2025 totaling up $210 trillion. I mean, it's kind of an insane number to think about. And basically, quarter over quarter from the fourth quarter of 2024, that amount increased by $23 trillion. or 12.8%. So basically there was at the same first quarter of 2024, we were at 206 trillion. So it's up about a little over $4 trillion year to year. So again, it's just absolutely an incredible amount traded in the derivatives market. Really, really pretty wild. So, but that's where we're at right now. Again, I always like to keep an eye on these things and just, understanding the size of the derivatives market and the type of products that are traded in the derivatives markets and why they're traded in there, and why the size of the market over the years has come down. But the apparently, they tell us that the embedded risk based on the bank's models and their risk assessment has, that risk has been brought way down through things like they said, level 3 trading assets. So again, just very interesting reports to look at. What can we take away from this? Well, we could take away that things are pretty normal right now. I mean, the mortgage market seems to be functioning very well at the moment, although we do need to keep an eye on those foreclosures. Spiked a little bit there in the first quarter, so we need to keep an eye on that. Trading activity and derivatives, pretty trading revenues a little down for banks, but overall, I mean, activity seems to be pretty decent. So, nothing too terrible at the moment. But like I said, I love these reports because they're nice and short. You can read them in just a few short minutes, get all the information you need, and kind of get in and get out. And it gives you some great details on kind of what's going on in the overall banking business. So again, hope people found those reports a little useful. If you do want to look at the reports, there are links to both those reports in the description down below if you want to go check them out. But with that, I will wrap up this episode by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below. And as always, please check out some of the other content on the channel. I thank you so much for listening. I hope everybody has a great day out there, and I will see everyone again real soon. Thanks a lot.